Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Parkamonic. How you doing, D?
Good morning, Will. How are you?
Average to below average.
Oh, really?
Yeah, well, I'm a big Jet fan. We don't talk sports that much, but there's been so much hype we brought in this quarterback, Aaron Rodgers. I mean, I'm sure you've probably read something about it. But so the whole family last night, I cooked a big meal. My son wants crab legs. We get the crab legs. This is the start of Aaron Rodgers and the Jets. What happens 4 plays in?
Gets injured.
4 plays he plays for the Jets. And it turns out to be his Achilles. It looks like it's his Achilles, and he's done.
Oh, sorry.
Well, let's start with the disclaimer. That'll make me more happy, I guess.
Well, you could cheer for the Eagles.
Yeah, I will for sure. I mean, listen, I'm a Jets fan, so pain and suffering is part of being a fan. But this is like, my brother's like, I think this is true that Jet fans have to live in purgatory. That's what his text was to me.
Oh man.
All right, let's do the disclaimer.
Yep. All right. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Another positive thing that's going to happen in my life today, which is awesome, is we're having the webinar with the IBKR at 2 today, right?
Yep. So today at 2 p.m. Eastern, we're going to be talking about the option pricing model. And I did push out a new feature last night, and it's going to help me in the webinar, kind of giving examples, how to use the option pricing model. You could change some inputs. So I'm going to cover that today at 2 p.m. We're going to go over the option Greeks, pricing options, hedging, a couple other things, and we'll do some examples with the new feature. So that's going to be at 2 p.m. Eastern today, and maybe tomorrow I'll continue on the new feature because I just pushed it out. I don't want to cover it now since we're going to do it at 2 p.m. But for those that can't make it, I'll take a look at it tomorrow. But today's webinar is on the option pricing model.
Yeah, and I did put the link. This is an IBKR webinar, so you have to register on their site. They hold those webinars, so you can go back and watch it as well. If you can't make tomorrow's shows with D, which you could also watch if you want at a later date. All the webinars we do, you can watch at a later date. But we've done, I think this is going to be the 28th or 29th webinar. So there's a whole library of videos we've done
with
IBKR shows on IBKR. So I'll put that link in as well.
Yep. All right. Thanks, Will. So let me share my screen. And if anyone's joining us for the first time, Will and I, we do these shows in the morning really to help answer questions that you may have about the Market Chameleon tools, the data, the analytics. If you have a question, type it into the live chat on YouTube. Will's watching it. He'll read them back to me. We also do provide a link to Zoom for anybody who wants to come on the show and ask their question live. So you could click on that link. It takes you over to Zoom. Once you're live in Zoom, there's a button, raise your hand. Click on that. Then we'll let you in. You can ask us your question live and direct. All right. So those are the 2 ways to ask questions. While we're waiting for more people to join us and to give a chance for you guys to type in those questions, we'll start out taking a look at the pre-market report to see if we could get some insights on what's trading in pre-market hours, and then we'll move on to the questions. So pre-market report, these are stocks trading in pre-market hours. I'm going to move down here, and we have 3 lists. Our most active stocks, the biggest percentage gainers in pre-market hours, biggest percentage decliners. I see there are 40 stocks that made our percentage gainers list in a pre-market hours, 33 that made our percentage decliners list. So from that perspective, looks like right now it's slightly bullish bias in a pre-market. So let's take a look at it from another perspective. We're going to move up here. And this shows us, it's a calendar view going back in time. Right now, we're on September 12th. And this is what's going on in pre-market hours from a higher level. So we have 309 stocks that are trading in pre-market hours, trading higher than the previous day's close. We have 313 stocks trading lower. If we took the volume of shares, or we have 143 million shares trading on up volume versus 45.6 million on down volume. If we converted the volume to dollar value, not all shares are the same. We got $473 million worth of stock trading up versus 1.5 billion trading down. So that's a little bit of a mixed signal. Almost even with the up and down, but if we converted the dollar value, the volume versus the dollar price, the dollar value, there are more stocks down than up, right? So $1.5 billion worth of stock trading lower versus 473 million higher. So those are kind of mixed signals there. I would say a mixed bag so far. One more check we'll do, go to the questions. We'll come down here and we see these lists of stocks. They have small cap stocks in there. We have ETFs in there, leverage products. So to make this list, it has to be a stock that's traded on a major US exchange. If it's trading at pre-market hours and meets thresholds that we set, it has to, based on volume, price movement, and liquidity in the pre-market hours, then it could make this list. So to narrow it down, we could use the filters above to narrow it down to a smaller group. If you have a watch list, you can filter by your watch list. I'm going to use this one in ETF filter. I'm going to click on it, drop it down, and get a list of ETFs to choose from. Let's pick SPY. That's the S&P 500 ETF. And when you click on it, the list below will get filtered by stocks that are holdings in that ETF that you selected. So the SPY is the S&P 500 constituents. And here we see 5 stocks made our percentage gainers list, 5 on our decliners list. Again, it's kind of a mixed bag. The only thing maybe that sticks out are the stocks that are trading lower, that are meeting our thresholds, are higher cap stocks than the ones that are trading higher. Yeah. So maybe I would say kind of split here. It's neither overwhelmingly bullish sentiment or bearish sentiment, kind of mixed bag so far in the pre-market hours. So I gave it a couple minutes. Well, if you have questions, I'll take them now.
No questions have popped up yet.
Okay. So there was an outstanding question. I don't remember exactly, the question or how it was worded, but something about, like tracking the accuracy of models or theoretical values. And so it's a good question, because any kind of model benchmark that you follow, besides setting it up, using the data, cleaning the data, there's always an evaluation or reevaluation and checking. How well does benchmark, how well does it work? How do you tweak it? How do you refine it? And we could do, hours and hours of this, right? Just on evaluation alone, just on cleaning data alone. So not something maybe we could do in like 5, 10, 15 minutes, because there's a lot of details that you would have to discuss, and even prior to that, before we get into the evaluation. But a couple like quick things though that I wanted to mention is, one is when we look at I think it had to do with the trade cards, actually. Let's just go here. So when we look at a trade card and we have a market price and theoretical value, right, for this option. So it's either a particular option or it could be a strategy. And in finance, when we look at securities asset prices, usually the very first thing as a professional you try to do is find the price of, what do you think the price is of that security? We do have a market price, right? So there is a market price, that is established through efficient, supply and demand and matching. But what is your benchmark? What is your theoretical value? What do you use, right, to trade around? It becomes very important, especially for options, completely important, for stocks and so forth. And there are different methodologies to do it. There's no one right answer. Okay. If there was one right answer, there would be no profit in it. There wouldn't be, it would always converge if there was one right answer. So sometimes you can, right, you can get an exact value or very close to it. Like, for example, if I take an ETF, right, I see what the price is of an ETF. But if I wanted to know what is the price of it if I had to recreate it, right? If I had to recreate this ETF, well, I could take the holdings. I know the weightings of the holdings. I know the makeup of the ETF, and I could recalculate it. I know the prices of each holding. I could recalculate it even in real time and see what that value is. But that's not always the case, right? It's not always that easy, and there's a lot of uncertainties. So the first thing, I do want to mention is, don't confuse a theoretical value with something like a forecast, right? So it's not a forecast of a value or what a stock, a stock or an option price is going to go to. It's a theoretical value. Is it an expected value? Is there a positive expected value? So I'll give you an example here. How people will tend to try to make an evaluation based on an outcome, right? So outcomes could be random, right? And you can't predict them. So if I gave you this example, I'm going to make it very simple, okay, guys? I'm going to try to make a simple example. And if you gave me two options, hold on a second. Why can't? I don't know why this is. Let me make the size of this bigger. I don't know why it's so small, but let's say heads and tails, right? You have heads and tails. Why is the size of this so small, Will? So let's say you have a coin, heads and tails, right? Heads, tails. So one way to make an evaluation, this is a trap. This is what 9 out of 10 people will do, right? 9 out of 10 people will say, well, what is the better bet, right? And you do an analysis and you say tails, right? Well, the person who asked that question doesn't ask you what the analysis was. They wait for the outcome, right? And let's say the outcome is heads, right? So let's say the outcome was heads. And they say, okay, let's do this again. What does your analysis say? What is the better? Let's say that's game number one. Game number two, what is your analysis? You do the analysis and you say tails again. Flip the coin, heads, right? And then you do that again, and it goes, let's say 3 times in a row. You do your analysis, and then you're like, okay, what is it? And you say heads. So the outcome is heads, but your analysis says it's tails. So 9 out of 10 people will say your analysis is bad, right? Without looking at the actual analysis. They won't look at, well, what is the reason? What is the reasoning behind the tails? We'll just say, based on the outcome, right? Based on that it landed on heads, the analysis is bad. 9 out of 10 people will say that. 1 out of 10 will say, okay, well, just tell me how you got to the tails, right? I understand. They'll understand that there's no way to predict it because it's a random event, right? There's no way to say heads or tails. But why did you bet on tails? 1 out of 10 people, maybe even less. So you say, look, here's the situation that I have a coin and I know that there's only 2 outcomes. One is heads, one is tails, and it's an even chance one, for heads or tails. It's a fair coin. But the person who gave me this bet said, if it lands on heads, I pay him $1. If it lands on tails, he's going to give me $2. Right? So even though at each level, let's make this even more egregious. Okay, so you guys will agree with me. If it lands on heads, I pay him $1. If it lands on tails, he gives me $1 million. Right? That would be an obvious bet. Right? Would that be an obvious bet to everybody?
Yeah.
So, So the analysis that you're doing is saying that there's a positive expected value, right? A positive expected return in the long term, even though I don't know what the outcome will be, right? There's no way to know the outcome, right? Because it hasn't happened yet. You have to flip the coin, and it's random, right? It's random, So I'm not trying to predict tails based on because 3 heads came out. That's not what I'm doing here. It's a positive because there's a positive expected return. That's why we chose tails. Okay, so number one, when you're doing the evaluation, right, this would be a mistake by looking at just the outcome, because you're going to get, sometimes you're going to be right on the outcomes, but it was still a negative expected return. Or you could be wrong on the outcomes, but it's still a positive expected return. But so if your model is not trying to predict what the outcome is, it's trying to establish what is a positive expected return, that's where your analysis should start. Well, how did you get to that positive expected return? Is that analysis correct, right? Is your model that's trying to calculate the expected value, the valuation, is that correct? So that's where you would have to start from in your evaluation. But I gave you a simple example here because there are only heads or tails. But this is 50-50. So what if most of the time you lose? I could have a wheel like this, right? So let's say I have a wheel with 10 different numbers, right? 10 different numbers, but I'm not going to draw all of them out, right? And again, you say, what is your analysis, right? What number should you come out with? And I say 10, right? Because my analysis says it's 10. So they spin the wheel, number 1 lands. Spin the wheel, number 3, and let's say you even have a game where it says either bet on 10 or the other 9, right? Any number from 1 to 9. Well, I bet on 10. So any number from 1 to 9 lands, I lose. Well, you're going to have a lot of losses, right? You're going to have a lot of losses from, because number 1, number 2, number 3, you have 9 numbers. 9 out of 10, you're going to lose, right? There are nine possibilities. You could lose, only one that you could win. So if you're making the evaluation based on the outcome, it's going to look like you're wrong. But what if I told you that the bet is that any number from 1 out of 9 lands, I lose $1. But if 10 lands, I win $1 million. So that should be obvious to everybody, right? You should be betting on 10, right? So obviously the payouts are not that egregious every time. They're much smaller, right? The expected returns, expected value, they're much smaller, but I'm giving you an egregious. So the evaluation starts with, how are you coming up with this theoretical value? How is it sound, right? Is it reasonable? So that becomes the question. That's where the evaluation comes in, because the outcome themselves, just like you spin a wheel, you flip a coin, or what is a stock going to be worth in 10 days? Well, we don't know, right? If we knew that, if we had a way to predict it, you would be the richest person in the world in a very quick, short period of time. So, then how do we come up with that expected value? So here, heads or tails. Well, this makes it a little bit easier, because number one, I know that there are only 2 outcomes, right? Either heads or tails. There's nothing else. And if you gave me the payout, right, $1 million heads, $1 tails, then I could tell you that the expected value of heads is, $500,000, right? 50% chance I win $1 million, 50% chance I lose $1. So it's a high expected return for heads. But that is when it's very easy, right? That's when you only have these 2 outcomes and somebody tells you the payout of each outcome. But the stock market doesn't work that way, right? The stock market doesn't have 2 outcomes to a stock, right? It's not like the stock's going to be 110 or 90 in 10 days, right? And it gives you equal odds of that, because it could be a lot of different prices, right? It could be 101, 102, 102 and 3 cents, 102 and 10 cents. And all that makes a difference. And there's no sheet, right? There's no, the New York Stock Exchange, the company doesn't tell you, well, in 10 days, here are all the outcomes that, for the stock, possible outcomes, right? And these are the probabilities. Nobody's telling me that. So if the stock is 100 today, in 10 days, we don't have a sheet to look at and say, okay, so there's a 10% probability that it'll be at 105. There's a 5% probability it'll be 99 and a quarter. And we don't have that, right? So that is a disadvantage, right? Since we don't have it, it makes life a lot harder to price things. But so what can we do? Well, now we have to create a model to try to estimate those things, right? That's the only way we can do it. We have to estimate it, because there's no way for us to know all these probabilities and all these potential outcomes. And also, there's no way even to estimate these exact things to the penny, right? So I can't, it's almost impossible to say exactly to the penny if you have a stock at 448.45. It's almost impossible to say exactly to what if the stock ends at 450 and 2 cents, what is the probability of that? Like that also it's like an impossibility, right? So you start putting things in bins, right? Think of it, things in like kind of ranges and bins. Like how when they do life expectancy, right? Like a person's life expectancy, they'll say 74 74 or 75 or whatever it is, right? But they don't give you an exact, it's 70, you're 74 and 10 days and, 3 hours and 2 seconds. They'll give you, it's kind of like you have to start putting things in bins and like ranges and stuff into reasonable, because it's almost impossible to do it that way. So keep those things in mind when we start to do estimates, right? When you're starting to do estimates, you're now looking at data with imperfections. So when we start talking about these theoretical values, right? When we talk about these theoretical values, I think the question had to do with accuracy, right? Well, so if I have a heads and tails and I know it's 50-50 and the payoff is $1 million and this is losing $1, then I could give you an exact expected value, right? Because I know all these things. But with options, you're working with estimates and uncertainties. So with the accuracy there, right, there's no exact accuracy, because what's happening is now you have to input data into a model that creates an output, right? So what's the problem with that, right? If we're going to be estimating these odds, right, the only way we could estimate it is use the historical data to try to create create odds, create handicaps, just like a football game, right? You never know. You guys ever see like the over under where they have they combine the score of both teams and say it's going to be over 44 or under 44? All right. Well, that's an estimate, right? That's an estimate based on some kind of data that they're inputting, right? They don't know, but it doesn't stop them from trying to estimate, right? Because if you use the data, you might not get exact, but you're not going to be like 1 million, right? Because that's not probable, right? You're not going to say 100,000. That's not probable. So you're going to get, by using the data, you're trying to get as close as you think your estimate can be to where reality will be at. Is the model practical, right? Is this model practical is what you want to try to establish. So what happens with the accuracy, right? If we're trying to estimate it, well, when you're working with data, right, there is always an issue with data accuracy, right? Data accuracy. You're constantly going, because what happens is you have incomplete. You could have incomplete data. You could, right? It could be imperfect data, because what am I feeding my model? Well, I'm feeding the data, but is there information out there that I don't know about? Yeah, probably. There's always probably information out there that you don't know about, or because there's lots of information out there and somebody might know information you don't, right? So that's always going to be an issue when you model things out. You have to compensate for that. You have to know that any kind of data you're feeding your model, it's subject to, imperfection. It could be incomplete. Okay. What else when we're using historical data? Well, the data itself, the analysis, right? It's non-stationary. So what does that mean? Let's say that I used 1 year of data to try to create the odds of something happening, right? Well, let's say I use the distribution of returns for a stock. Well, the distribution of returns may not look the same from 1 year to the next. It's not always stationary. It's not always exact. So it's moving. So, you have to keep that in mind, that you're using the data, the best available data, but it's not always stationary. It's not always going to look from 1 year to the next, even though the whole set of, even if you have this big data set, it could change over time. It's not stationary. Okay. So sometimes it could go in your favor, sometimes it could go against you, but you have to, you have to understand that. I think this is the question. I'm not sure, because we didn't have the person come in.
Yeah, Corey didn't jump back in this morning, but if he comes in, I will share this video next time he comes in and I see him. But he's not here right now, but we can always share it. It will live there forever. Great job, my friend.
Okay. Well, there's more to, yeah, I think we're at 9:30, but
We are.
I'll try to talk more about it. Before we input data into a model and get an answer, it's important to understand, well, what are we trying to calculate? What are the weaknesses? What do we have to keep in mind? Those are going to apply to most models. Okay. There's no way around some of these issues.
Actually, Corey is in. He just typed in thanks. So
okay.
I guess you gave a good enough explanation. The guy, I know he's asked twice, so that was helpful.
Right. So,
and again, Corey, if there are other things you want to ask, email support@MarketChameleon.com. That is on the website and easy to find.
yeah,
awesome job, buddy.
Right. And we'll go over, look, there are more things with data that you should know about. These isn't complete. I just started it out. But we'll talk more about it. But it's important to understand these models, because what is the benchmark telling us? How can we trade around it? How can we improve it? And a lot of times it's not even something to trade around. Once you have your base model, it could point you to something that you would not have known. Like the market is signaling something, but you would not have realized it without having your base model. Okay. So everyone, look, we're doing another webinar at 2 p.m. Eastern today with IBKR. You do have to register with them. Hopefully we see you there. If not, hopefully we see you guys tomorrow.
Yep. And that link is in the chat. So click on that. You have to register on Interactive Brokers website. And I will also share a link at the end of this video, at the end of the show on the YouTube chat with that takes you to the Interactive Broker library. They've got all our videos. So anyone who hasn't seen that before, it's a great resource, as well as our YouTube channel. Awesome job, buddy.
All right. Thanks everyone for joining. Stay safe out there. Hope to see you guys later.